Hello and happy Monday. Purse Strings is here with you today live. Purse Strings is here every week to provide some tips, tricks, some good knowledge and nuggets to learn about and then to walk away with. And when you need a professional then to put things in transition or transaction, we have top tier financial professionals willing, ready, able to serve you. They love serving women. And so we call those our purse strings approved professionals. And they are the ones who are also coming on every week and providing this great education. And so today we have Sandy with us, and we are so excited to have you on. Today we're going to be talking about being in a volatile market and tips for the volatile market. We're going to keep working on that word today. We know we're going to stumble over it. Sandy and I were just talking about that. But before we get started, Sandy, could you give a little introduction about who you are and what you do?
Sure. I've been a financial advisor and certified financial planner for over 25 years, and I specialize in helping female professionals and small business owners prepare for a financially sound retirement.
Nice. And where are you calling in from today?
I'm actually in a hotel room in Pittsburgh, Pennsylvania. We're here for my husband's high school reunion.
Oh, fun.
Yeah. So
Well,
home is really Sarasota, Florida, but I'm quite a distance from there today.
you definitely are, but I'm glad you're able to come on and talk to us today.
Thank you.
So as we know, this group that we are talking to is our 50 plus and fabulous women, which we love to talk to, but those women are much closer to retirement. So I know this volatile market is a big deal. And so we're going to be talking about some top things to do in this market. So I'm just going to let you get started with, tip number one.
Great, great. Well, first of all, I think we need to remind everybody that we really are going through really an unprecedented time right now. We've got the first war in Europe that we've had since World War II ended. We've got a worldwide food shortage. And a lot of that has to do with the fact that Ukraine is not able to ship its grain out because of the Russian invasion. We're still in the midst of a pandemic, which we certainly haven't had one of those in over 100 years.
Right.
We've got the worst inflation since the 1980s. The S&P 500 index is down 25% year to date. And there's a whole lot of volatility in all the world's markets. So I think this is a particularly timely topic, what to do during this volatile market. So my first tip is certainly don't panic. Don't panic because, when we panic, we do irrational things, and that's never a good strategy. We all know what successful investing really means. It means buying things at a low price and selling them at a higher price. But if you look at the charts going back 50 years, we can see that the vast majority of investors do it just the opposite. They buy things high and then they sell things low after the market has already dropped. So not a good idea to panic. It's my job during a volatile market to keep my clients informed about what's happening, remind them about why we're invested, and prevent them from doing something that they really shouldn't. For instance, I had my client Paula call me early March, right after the Russian invasion, and she wanted to turn on the income stream in both of her annuities immediately because she thought the world was coming to an end and she thought the insurance companies were going to go out of business. So we talked for maybe 45 minutes and I listened to her concerns. And I told her I would find the paperwork that she needed to turn this on and that I would be back to her later. By the time I got back to her the next day, she had reconsidered, decided that she was panicking a little bit and that she was just going to hold on and wait and see what happened first. So there again, if you're nervous, call me. We'll talk about it. Maybe make a tweak or two in your portfolio. But I'm here to hold your hand and get you through these volatile times. So tip number one, don't panic.
I think that's much easier said than done, but I understand why you have a professional. As we always talk about money, it's always an emotional thing. And so it's always easier to hand that off to a third party who's not as emotional so they can think logically, because we know we never think logical when we have a lot of emotions going on. So I understand, how your client could feel that way. I'm glad she had 24 hours to sleep on it, for sure.
Yeah.
Which is really important. So step one,
Right.
let's all take a breath, not panic.
Yeah.
What would be step two?
Number two is to make sure you're well diversified. Every portfolio needs a portion of your money in stocks, in bonds, and in cash, because the three asset classes generally do not move in the same direction at the same time, which means that a portion of your money is protected from risk at all times. The challenge is to find the right mix, and a financial advisor will typically ask you a lot of questions and maybe even use a certain program to help determine what the sweet spot is for you. But once you find that sweet spot, if you're well diversified, there's no reason to start making radical changes during a volatile market. So I think that's the key to begin with. Let's make sure whether it's 70% stocks, 30% bonds, 60-40, 50-50, find out what's right for you. And then we don't have to worry when we go into a volatile market. We can pretty much stay where we were.
So it's planning ahead. Amazing.
Right.
I know they usually call that, now I'm totally blanking, your something index. When you take the quiz of figuring out what your, I'm going to blank on the name. I'll come back to it.
Okay.
But yes, well diversified. Don't want all your eggs in one basket is really
right.
what that means in plain English. Because, we all see what things can happen, so you don't want too much anywhere.
Right. And it was easy last year with the S&P index up over 28%. You might have started out 60-40, but you ended up, 80-20, just because stocks grew so much and it threw everything out of whack.
Right. That's a great point. I just thought of it. It's your risk tolerance is what we talk about. And so when you kind of figure out what you're willing to risk and what you're kind of comfortable with, and that's a conversation you usually have with your financial professional before you even jump in, before crazy markets hit or anything like that.
Correct.
All right. So first of all, don't panic. Second of all, be well diversified. What would number three be?
Number three is keep contributing to your 401k plan. Often the first thing we want to do when we see our account balance dropping is to stop adding money. But really, if you're adding money by practicing a tried and true investment strategy called dollar cost averaging, putting the same amount of money into the account every month, if you think about it, you're actually buying more shares as the price drops because the shares are on sale, so to speak. And that's going to minimize your risk. So even though you might be afraid and concerned about seeing that balance drop, this is not the time to stop investing in your 401k. Make sure you're making those contributions in a timely fashion.
All right. So keep investing in that 401k. Yeah. Would you recommend, and I mean, not recommend, but if people had extra money, is it better to even throw more at it since you are getting more, since they're kind of on sale?
You could certainly do that. Or, maybe if the 401k, we've got it set up so we're putting in the right amount to get us to our goal when you're ready to retire, you could certainly put some money into an IRA or another brokerage account, some type of tax deferred investment account. It just depends on your individual situation, but that's certainly an option.
Definitely. So I don't know how many tips we have. So do we have a tip number 4?
We have 3. Yes, we've got tip number 4 coming up. Stop looking at your account every day and take with a grain of salt what all the market pundits are saying. We all know that the media has to make things sound dramatic to drive up ratings, but you're only going to hear bad news if you tune in. So rather than looking at your account every day, look at it once a week and stop watching the news or reduce the amount of news access you've got and listen to it less. If you're in good investments to begin with, investments that have done above average for a long period of time and have professional money managers who've demonstrated their expertise, just sit back and relax and let them do their job, and don't don't tune in every day and make yourself even more nervous.
Yeah, that will help with the not panicking,
Right.
That will definitely weigh it out, because it is true with the news, it's always breaking news, because that's how you're going to get attention these days.
Right.
So we're not going to see the great things on there, and there's nothing we can really do about it at the end of the
No,
day.
there really
So
isn't. Yeah. You hear the word inflation. If you watch Squawk Box or Fox Business in the morning, like I probably do, you hear that word inflation like 75 times an hour. And, there really is no way to measure when we're in an inflation. Typically, we don't know if we're in one until it's over. So everybody can give their expertise and their prediction, but nobody really knows. And all it does is just make everybody nervous.
that's a great tip. I really like that one, because yeah, you just can't keep your eye on it. There's not much you can do. So just tune out, take a breath. It's all going to be okay.
Right.
Do we have a tip number 5, or those
We
are
have
4
a
tips?
tip number 5, yes, and this is
Okay.
maybe one of the more important ones. Find a financial advisor that you know, like, and trust, and start working with her today. Most of us don't have the time or the expertise to do our own investing. So find a professional who can do it with you. I can almost promise you that your long-term returns will probably be a little bit better. And don't let cost be an issue. I think often people don't want to consult an advisor because they think it's going to be expensive, but financial advisors can be paid in numerous different ways, and we can certainly set up a plan that works for everybody. I think the value of a financial advisor is we're going to treat you holistically. If you have an insurance agent, he'll gladly sell you a life insurance policy, or a broker will gladly sell you shares of a mutual fund or a stock, but nobody knows how all the parts and pieces fit together. A financial advisor will let you know that you need a life insurance policy with a rider that will let you use part of the death benefit to pay for long-term care if you need it. Or a financial advisor will tell you we need to shift money from stocks to bonds because of volatility. A financial advisor will let you know that you're going to have to start contributing more to a 401k plan if you still want to retire in 5 years, or that you need to set up a health savings account to pay some of those out-of-pocket costs because of your high deductible healthcare policy. So a financial advisor will bring everything under one roof and, like I said, treat you holistically. Whereas if you've got 6 advisors doing 6 different things, you're just not going to get the same advice and the same expertise. So if you need somebody who can be there with you for the whole journey, and you're looking for a travel partner, I invite you to call me. And I think my phone number and email address are on my profile on purse strings.
Definitely. They definitely are. And we also agree that, you do need a financial professional that can help you with the emotions on this, journey, or making sure you hit those goals that you have of, retirement and living your best life. Because it is important to protect ourselves and our families, because women live a long time. So we got a long time left ahead of us. We got a lot of work to do.
Right, exactly.
And they can really help you in this time, because I don't know about you, but I don't have time to be researching all these things along with my job. So I'm going to leave that up to someone who does that full time and gets paid for it.
Yeah.
It'd be worth the investment.
Yes, I definitely think so.
Awesome. Well, I think we've had some great tips today. Do you just want to go through all 5 real quick and just reiterate them for anyone who just jumped on at the end?
Yeah. The first is don't ever panic. I'm here to hold your hand and get you through this, but panicking always causes irrational actions, and that certainly is not going to help us grow your portfolio over the long term. Second is make sure you're well diversified. Work with an investment professional to find out what your sweet spot is. And then when you head into a volatile market, we don't have to start making radical changes because everything's allocated the way it should be for you. Third, keep contributing to your 401k plan. Dollar cost averaging will average out your cost basis and actually protect you from some of that risk with the volatile market. Fourth, don't look at your account value every day. and tune out. Don't watch Squawk Box every morning. Maybe just a couple of times a week will be better, because that just causes panic as well. And finally, I really do advise, find a financial advisor who you know, like, and trust, and start working with that person. Let them help you and let them guide you where you need to go.
Awesome. Well, thank you so much, Sandy, for coming on
Thank
today,
you.
for sharing your expertise in this time that we're in. So anyone can always reach out to Sandy. Her email is at the bottom. She's also a Purse Strings approved professional, so you can check her out on our site, pursestrings.co. And we will be here again next week with another Money Monday, and reach out if you have any questions until then. So thank you again, Sandy, and we'll talk to everyone soon.
Great.
All right.
Thanks.
Bye.